Hi class. In this video we're going to look at some examples from chapter 5. So let's look at this one first. It says record the journal entries for the above information, and our information that is given says on April the 25th, Foreman Electric installs wiring in a new home for $2,200 on account. And then they have an allowance because of a problem, and then the customer makes full payment of the balance owed excluding the allowance on April the 30th. So there's 3 entries, one to record the services revenue, one to record the allowance, and then finally to record the payment on account. So when we record the service revenue, let's see, did it say they paid us? Oh, no, we provided that on account. So we provided services on account. We now have accounts receivable because at some point we're going to receive payment on that amount, $2,200. And we're going to recognize revenue for the full amount. So I think they're calling that services revenue. And then we got to go to entry 2. It says record the sales allowance. So we had a problem and we gave them an allowance of $470. So when we give somebody an allowance, if they owe us money for that job, which was an accounts receivable, we're going to actually reduce the amount they owe us because there was a problem with the job and it didn't pass. So in the first entry, we debited accounts receivable for the full amount that they owed. To get rid of part of that accounts receivable, we're going to have to credit accounts receivable for the amount of the allowance. And the allowance is on a sale, so it's called a sales allowance. That's a contra revenue account, so to increase a sales allowance, we're going to debit it. Then number 3, they are recording the cash collection, so essentially they're paying us cash for what they owe us, which is an accounts receivable. And the amount they owe us would have been the $2,200 less the allowance that we gave them. So $2,200 minus $470 is $1,730. And I always like to check my work just to make sure that I haven't done anything strange when I was doing my calculations. Make sure I've got my formatting correct. And we've got incredibly slow internet right now. Yep, so that's what yours are going to look like, something like that. And then, let's see. I'm not going to go into number 14, calculate the net revenue, but basically net revenue is their total revenue less your sales returns and allowances. So that should be a pretty good hint for you. Let's go forward a little bit. All right, so this says Physicians Hospital has the following balances, blah, blah, blah. We have an estimate to uncollectible account that's 10% of accounts receivable. It says record the adjustment for uncollectible accounts on December the 31st, 2018. So it says that they estimate their uncollectible accounts to be 10% of accounts receivable. And we know the accounts receivable amount because they tell us so. $55,000 times 10% would be the amount that they think they won't collect, which is $5,500. So the amount of this $55,000 that they think they won't collect is $5,500, which should be the balance in the allowance for uncollectible accounts account. It looks like they already have an allowance amount in there. They have a credit. So we're going to have to take that into consideration. So when you're adjusting that allowance for uncollectible accounts, that account actually offsets accounts receivable. So the balance in account in the allowance account actually serves to decrease the value of accounts receivable by offsetting it by the uncollectible amount. So we have accounts receivable of $55,000, and that should be offset by an allowance for uncollectible accounts that should have a balance of $5,500. That's a credit. So that credit balance in the allowance account offsets the debit balance in the accounts receivable account. So we need a $5,500 credit balance in the allowance account. That being said, we already have some of that balance in there. So we need $5,500 as a balance, but we already have $1,200 in there. So we really only need to put $4,300 more into that allowance account. So we're going to credit $4,300, which is just the difference in what the balance was and what we needed it to be. And of course, if we have a credit of that amount, we need a debit of that amount. And that will go into bad debts expense. So most of the time, there's going to be a credit balance sitting in that allowance account. So you're going to take the difference in what you need and what's already in there, and that's going to be your credit. Sometimes it works out that you might have to debit that allowance account to bring the balance down. That can happen. So it's not always a credit to the allowance and a debit to bad debt expense, but in this case it is. You just have to do whatever, either debit or credit, whichever you need to do to make the allowance balance be how much they think they won't collect. And let's look at one more. All right, so this says on April the 1st, Shoemaker Corporation realizes one of its main suppliers is having difficulty meeting delivery schedules. The supplier has a lack of funds, blah, blah, blah. So we are dealing with a loan. So Shoemaker agrees to lend the supplier $460,000, and it's a 12-month note at 10% interest. So we've got three transactions we need to record. The first one is the making of the note receivable. So if we are loaning somebody money, that is a note receivable. That's an asset, so it gets debited to go up, and we're giving them cash, so that is the credit. And the amount of that is the amount that they loaned them, so $460,000. So that's the only entry we need to do to record the issuance of the note. And then, well, let's go back just a little bit. That was on April the 1st. The note is a 12-month note, so it's not actually due until the next year, so 2019. So when a note straddles a fiscal year, then we have to do an adjustment to record the interest expense in each year, so that we match our interest expense with our revenue for that year. So this is the adjustment for accrued interest. So we're accruing interest, so the debit's going to be the interest expense. We're just making sure we record that expense in the year in which it should have, I'm sorry, it's not interest expense, it's interest revenue because they owe us. Let's do it this way. So interest revenue, because we gave them a loan, so they owe us. So we're recording the revenue in the period during which the money's been outstanding so far. So we've actually had, we loaned them that money in April, and it's now the end of December. So we have 9 months of interest that we've actually earned because they've had our money for 9 months. So we're going to credit interest receivable, and then the debit should, we're going to credit interest revenue, and the debit should be interest receivable. We get these terms right maybe eventually. So that amount would be the amount of the note, which is $460,000, times the interest rate, which is 10%, times the period of time. And the period of time is April 1st through December 31st. So that's 9 months out of 12. So $460,000 times 10%, times 9 months divided by 12 months. Looks like it's $34,500. And that's the interest that we've earned so far. And then we're going to collect cash. So if we collect cash, it's always a debit. They are paying off that note, so our note receivable is going to be credited because we're going to take that off of our books. The other receivable that we're going to have to take off our book is the interest receivable that we recorded in entry number 2, because they're going to pay that as well. The final thing that we need to record is interest revenue. And that's because we only recorded 9 months of interest up to this point. That was through December, but we still have January, February, March interest to also record. So when you make an entry like this, when you record notes receivable, whether you're putting it on the books or taking it back off the books, it's going to go on and come off at the face value of the note, which is just the amount that you loaned them, or in the case, if it was the reverse, the amount that they loaned you. So we loaned them $460,000. So that's the amount of note. And that should make sense to you, because over here we had a debit balance in notes receivable. We need to get rid of that note off of our books, so we need to have an equal credit to wipe out that $460,000 debit. Our interest receivable was what we did in entry 2. So we debited $34,500 in interest receivable. We need to get that off of the books, so we're going to credit it. And we need to record the other 3 months of interest. So that would be $460,000 times 10% times 3 months divided by 12 is $11,500. So you should be able to see the total interest here was $46,000 right there. And that's the interest for 12 months, but part of it was last year, or in the first year, and then the other half was earned in the second year in those last 3 months. So together they make up 12 months of interest. And that's actually how much we're going to get. The people are going to pay us $460,000 because that's what we loan them. But they're also going to pay us 12 months of interest, which would be the $34,500 and the $11,500. So the total amount that they're going to pay us and the amount that it takes to get our debits in balance with our credits is $506,000. Now let's just see if I did my math right before we call it quits. So yours should look something like that. So I hope this helps as you do your homework, but as always, if you have questions, feel free to ask.